Good morning. I'm Mark Franson, a partner in the law firm of Chapman & Cutler, which is a national financial services firm that works in the fintech and marketplace lending space. And as we do every year at LendIt, we publish the booklet, The Regulation of Marketplace Lending, which not only talks about recent updates, but also the historical aspects of this industry and the laws and regulations that affect it. So please feel free to stop by our book and get a copy, or scan our QR code to get it electronically, or visit our website, chapman.com, to get your copy. Today, we're here to talk about the future of the bank partnership model, and it's a pleasure to have with us Brian Graham. After degrees at Harvard and Stanford, he became a congressional staffer, has been in the financial services a long period of time at Fannie Mae, and has also been the CEO of Bank Alliance, which is a network of community banks and that provided services to all of those particular banks, and now is a partner in the Claris Group, which gives strategic and regulatory advice to fintechs and other institutions. And so as we said today, we are going to talk a little bit about where does the bank partnership model go from here. As was alluded to, the bank partnership model is under scrutiny. We all know that. We survived the Madden case and valid when made rules. But we also know that states are passing laws, particularly directed at the bank partnership model, commercial disclosures on the commercial side, and usury and licensing issues on the consumer side. We know that regulators are taking a closer look and examining bank partnership programs more closely, and that raises the cost of compliance. We know that there are true lender and other types of lawsuits out there challenging these things, including the case in California, which could determine the future of bank partnerships. And finally, we have the fact that investors' appetite could be quelled a little bit by a CFPB case that's now at the Third Circuit that could impose liability on securitization trusts. That could affect the investment in this particular asset class. So there's a lot of things going on. In addition to that, we've got a not-so-friendly credit cycle. And we all know that it's not been a great year either for fintechs or for banks. And so with that rosy background, Brian, sort of how are fintechs looking at banks and banks looking at fintechs, and is it going to have implications for what's going to happen down the road for the bank partnership model?
Well, with that intro, I think we all need to get to the bar immediately. First, I would just say that there's nothing new about partnerships between banks and non-bank financial services companies. We're talking 50 plus years of this kind of a model being in existence, and it's in existence for a really good reason, which is that banks have certain things that non-banks don't have. And non-banks tend to have things that banks don't have or can't do well. So banks have access to the payment system, and they've got the ability to export interest rates and insure deposits, all of which are kind of a monopoly for the banks. And conversely, the banks aren't particularly good at innovation, or in some respects at customer service. So this isn't anything new. I would also say that the regulatory stuff that's happening, and there is a lot happening, most of which is happening beneath the surface. The things we can see are the public enforcement actions and litigation, statements and speeches and guidance from the various regulatory agencies. But most of what's happening is happening at the supervisory level through examinations, and there's a lot of that going on. I don't think it's any surprise that it's happening now. And I don't think there's been that much of a change in regulatory expectations. There's probably been a little bit, and there probably will be more going forward as regulators react to the mistakes and excesses of the last 5 or so years. There's an inherent lag in when regulators kind of focus on issues. And if you think about any graph that showed, the number of fintechs, the dollars that went into investment in fintechs and all those kinds of things, the last 5-6 years have been clearly up until about a year ago, have been a massive boom of that activity that created a lot more bank partnerships. A lot of banks got into the partner banking business, some of them not really planning ahead. And so I think what we're seeing is kind of this inevitable result of that cycle, and it'll continue to play out. I don't think it means the death of partnerships, because they're essential and necessary. It just means that the standards that applied, 5 years ago, or should have applied 5 years ago, are being enforced. And in the long run, I think that's a good thing for both fintechs and banks. So
do you think that means that sort of the fundamental relationship between banks and their fintech partners are going to change? Are banks going to get more into the picture? I mean, some would say for a certain degree of things that some of the banks pushed off some of their responsibility off to the fintechs, and now we are seeing the regulators come in and look at various aspects of that. What's that going to mean for both the fintechs and the banks from the regulatory side?
Well, I think by and large, it's going to mean that everybody's going to need to follow the rules that were in place 5 years ago. There's no change in the regulatory expectations at a fundamental level. The banks are responsible for whatever their partners, vendors, fintechs, whatever are doing. They were responsible for that 5 or 6 years ago. To the extent a bank, as you said, pushed off those responsibilities to somebody else, they made a fundamental mistake. And the regulators should hold them accountable for that. I think what's going to happen to these partnerships is that they're going to be harder to execute well, because the standards to which banks are going to hold their partners are appropriately going to be high. And so, if you wanted to find a bank partner that could get you to market in 3 weeks and wouldn't ask any hard questions and really wouldn't dig into your business model and wouldn't kind of audit you and all those kinds of things that can be annoying and painful, that's not okay. And it wasn't okay 5 years ago, and it won't be okay today and going forward.
So do you think that's going to make it a little bit tougher for new programs to get into the space?
Absolutely. I think it will. But I think what it also will do is allow companies that have sustainable business models to have sustainable partnerships that can stand the test of time, because they're built really to last and to meet those regulatory expectations on a go-forward basis.
So it seems in some part that the costs of compliance will increase and go up. Is this going to cause any disarray or disruption of the economics between banks and their partners, or are we going to have an adjustment for those kinds of things, or how are those risks and costs going to be shared?
I think there will be adjustments to the kind of baseline economics. There's another piece of this, though, that I think will be more disruptive, which is there's going to be a cleanup phase here of partnerships that were not done well, either by the bank or the fintech or together. That cleanup phase is going to result in problems. There's going to be enforcement actions. There's going to be fintechs that are basically off-boarded. There's going to be disruptions to the flow of transactions and to growth and to the addition of new products. I think in the long run, that's going to create a much bigger emphasis for both banks and fintechs on the resiliency of their partnership relationships, as opposed to the speed and simplicity and ease of those partnerships.
And that's not always something that fintechs seem to be wild about, not going fast in this environment. So there's a tension, that I think fintechs are going to face in terms of having to deal with this bank structure. And I think you're right, it's been there, but it seems like it's going to have a little bit more emphasis in the future here.
I think that's right, and what I would say to fintechs is tough, right? I mean, if you want access, if you want access, the government appropriately regulates financial services. And if you want access to key parts of the financial services system, to the payments network, to insured deposits, and all those kinds of things, there are responsibilities that come with that. You as a, if you want to have a bank partnership, you have an obligation to stand up to those responsibilities in an appropriate way. That requires some work. Just as figuring out your user interface requires work, or your customer acquisition strategy, or your marketing strategy, figuring out how to handle the compliance side of things and everything else is at least as important.
It was sort of interesting, someone stopped by our booth this morning, and I mentioned to you earlier that he said, I don't want anything to do with these bank partnership models. I'm going to go out and get licenses in all the states and do my own thing and be in control of it. Do you see that as a trend, or are we going to see more of that? Are we going to see a balance of things, or is there a fundamental shift, or is the partnership model sort of here and always to stay?
Yes. So I think the partnership model is here to stay because there are certain things that you cannot offer without access to a bank partnership. You cannot offer, if you're a neobank, or whatever we're calling them these days, you cannot offer an insured deposit account without a bank partner. It doesn't work. If you're in the payments business and you want to go around and get money transmitter licenses in X states, you can achieve that. If you're a lender and you want to be a state licensed lender, there are ways to do that as well. I think it all depends on the business model.
And we've seen, for instance, recently a bank in the partnership space having some issues on fair lending, and we know that fair lending has been a topic of interest to the regulators. And as a result of that, there are some changes that bank's going to have to do in terms of its partnership model. What other areas do you see the regulators perhaps focusing in on, and the consequences of what those things might be, and whether it's this cleanup phase, or is there something else coming down the road as well?
Yeah, I don't think it's any different than what a bank's being scrutinized by the regulators on their non-partnership business activities. So it's BSA, right? Big area of focus for the regulators. It's clearly fair lending and the related things like model risk management and governance and all that kind of fun stuff. It's also third-party management and the kinds of things banks are expected to do with respect to their service providers and their vendors and those kinds of things. I don't think there's any magic to where the regulators are focused. I don't think, frankly, there's anything surprising or different about it. It's just that I think some banks and some fintechs didn't do what they're supposed to do, and they're going to be held to account, and that's probably the way the system should work.
So you talked a little bit earlier about the notion of, rather than fast and quick, doing things that are going to be durable and resistant. So how do banks and fintechs get there?
So I think it's fundamentally about incentives and the way the incentives work for both the bank and the fintech. And for too long, the incentives were, I want it fast, I want it quick, I want it easy if you were the fintech. And that resulted in banks coming to the top of the queue, of your prioritization queue, that probably weren't doing everything they should be doing. And in the long run, in the short run, that probably felt like a good answer because you got to market faster. Nobody bugged you about certain things. In the long run, that's not gonna work. I think what's going to happen is that's going to get flipped because people are going to have some tough experiences, probably already are having tough experiences as a result of some of the deficiencies in their partnerships. And that's going to cause a much bigger focus on making sure their bank partner actually is doing what is expected and required. In a weird way, I think that the fintechs that are really looking to build durable businesses that'll be there for the long run will want banks that are asking those questions and making those requirements and demands, because that'll stand the test of time. And if you're a bank, if you find a fintech that kind of resists that, that's probably a good measure of the situation and a partner to avoid.
A red flag, no doubt. Yeah. And of course, there's another whole piece of this picture, right? And that is that so many of the marketplace assets are sold off into the secondary market, that securitizations are a huge part of the liquidity and the financing of this particular market. And so are these regulatory issues, is that going to sort of quell the appetite of investors? Is it going to cause them to enhance their diligence, which in many cases already is somewhat robust? Will they avoid the thing, and will that cause an issue in this space?
You're talking about securitization markets
right.
specifically? I think most of the things that are coming to the surface, let me flip it around. Most of the things that are directly relevant to the securitization markets have long been in the water, right? True lender, that kind of stuff. Most of the things that are coming to the surface now are more things about what the bank did or didn't do that really are about consequences for the bank and or for the fintech partner, less about the, some kind of impairment or challenge or other implication for the assets themselves. That's not to say there aren't those circumstances, but I think it's predominantly about the institutions and companies and their behavior as opposed to the loan assets that spit out the other side.
Okay. And I know in a securitization field, for instance, you'll oftentimes see the eligibility criteria being changed. There was this case out in West Virginia on cash call, so we're not going to take any West Virginia loans, and there's this over in this particular state. And as we see more and more state action and maybe even lawsuits, is this just going to keep cutting assets out of the mix? And how do banks and fintechs sort of deal with this ongoing development of state laws that really are aimed to some degree to impact the model?
Well, I think that the short answer to your question is yes. To the extent state laws make it untenable to originate certain kinds of assets, they're not going to be originated, and what have you. The big question, I think, is for the states, for the state regulatory agencies, and the legislatures, is to strike the right balance between consumer protection on the one hand, and consumer access and financial inclusion on the other. And I leave that to them. But yeah, to the extent that a particular state passes a law or there's a piece of litigation that results in a court decision that makes certain types of lending unattractive in certain states, that's it's going to continue to be a problem.
Right. And of course, we've got the ongoing case in California. That would be a huge implication for the market if something negative happened out there. But it again points not only to the theme, I guess, of our sessions here, that talking with regulators are important, but also the importance of the right kind of compliance, doing it right, and having all of those things in place. We've only got a minute or so left. Do you see any other sort of big things happening, or what does your crystal ball say about the future of the bank partnership model?
I wish I had a crystal ball. I wouldn't be sitting here in this conference.
That's both of us.
Yeah, exactly. Look, I think that the next year or two is going to be a tough year for bank partnerships because of the cleanup phase. And the interesting thing will be what emerges out the other side, because I think the partnerships that do survive, the new ones that are created, will be in a much better position to stand the test of time. And it'll be interesting to see how all the fintechs and the banks react to that dynamic.
And the other thing I think that's going on here too is that when a lot of those original partnerships were put into place, some of those agreements are sort of coming to term, their expiration points. So there's going to be an opportunity to look at the terms of those particular agreements, to renegotiate those particular terms, and to build in some of these costs, incentives, and things to drive the durable and not the fast.
Exactly.
Great. We are out of time. Thank you very much. Thank you, Brian.
Thanks, Mark.